Hey, everybody. This is Carl with Gold MF, and we are here today for our third episode of the CRE Playbook, where we'll talk about strategies, tactics, and deals and how to get into and continue your investing journey. So, where we're at right now, where we're at today, November 2023, we've been on this crazy cycle of inflation and interest rate hiking. And what we want to talk about a little bit today is going to be macroeconomics. And how does macroeconomics impact you? How does it impact your investing? And what you should be doing in order to adjust your investing strategy based on today's and tomorrow's outlook for the larger economy as well as the micro economy, right? If you're in real estate, which most of you already know, I am personally invested and heavily invested in the real estate space. Most of you know that there is no necessarily global economy that governs what's happening in the real estate space from an asset valuation standpoint. However, there are micro economies, right? Meaning, if we look at the state of Washington, the city of Seattle, greater region, the Northwest, even there are markets, there are micro markets, and we invest based off of micro markets. However, we still want to make sure as real estate investors that we're paying attention to what's happening in the macro economy, so that way we can make sure that we're using wise decision making in our investing. So that way, again, we are doing our best, whether it's for ourselves or with others, that we're investing with as many tools and resources that we've got. Mentioning resources, one of the things that I want to talk about today is going to be what resources do I personally use to monitor the macro economy? What podcasts, what books, what journal articles, what publications do I regularly subscribe to? So that way that can make and that can help my whole round me out in terms of the macroeconomic outlook. So again, we'll talk a little bit about that, and obviously how all of that interplays and how all of that should govern your investing decisions. One other thing to mention before we get into the today's show is going to be interviewing, right? So we're going to be having a podcast guest on sometime later this month in 2 weeks. So excited to announce who that's going to be next week. Next week is Thanksgiving. Really excited about that. We'll have some great family. We'll go over to family's house and celebrate with them. Now, without further ado, let's get into some macroeconomic discussion. So, obviously, the biggest thing, the biggest elephant in the room, is the Fed decision on whether or not we're going to continue pausing, increasing rates. Right, the essential battle of rising inflation and what we've been in for the last, let's say, 12 to 18 months, roughly. Now, let's rewind a little bit, right? 2 years ago, maybe even closer to 3 years ago, we started realizing some inflation issues, specifically between the supply constraints, labor demands, all related, mostly related to the coronavirus pandemic that happened, that came over in early 2020. And so since then, at the onset of that, we had this huge bottleneck in terms of material and labor, which caused this artificial demand for a lot of things, right? Materials, labor for rehab, and then going into the actual assets, the actual buildings, the homes and the apartments and the different types of real estate itself. That caused this massive bubble, massive demand for all kinds of things. And so that caused, right, this imbalance of supply and demand really led to a lot of the issues that we're dealing with right now related to inflation. And so, you know, the Fed's job, the Federal Reserve's job, right, Chairman Jerome Powell, their job really is to make sure that we are tracking towards a predetermined 2% inflation rate on an annual basis. And so, what is that, and how is the Fed's job, and or rather, how what are the tools that they've got in order to combat it? Right, it's super limited. They've got their primary one, which is interest rates, right, increasing or decreasing interest rate to help spur demand. or stifle demand. And with the demand equate part of the equation, that's going to impact supply. That's going to impact pricing. So that is their major force. That is their major lever to combat inflation. Now, the other side of the equation is going to be the job market, right? What's happening in the job market today? We are today again being November 16th, 2023. We just saw, I think, week 3 in terms of dropping, rather increasing jobless claims, which is starting to show cracks in the job market, right? This is the lag indicator that the Federal Reserve wants to see, where the job market is starting to soften, right? Why is that? Job markets are certainly the other part of the equation that shows that inflation and helps alleviate some of the pressure on the inflation standpoint. So the other lever really that that the Federal Reserve has is also to impact restrictive restricting the actual supply of capital, supply of credit. And so that is the other big area that the reserve Federal Reserve has to impact inflation. And so what does that mean for us as real estate investors? It really means two things, in my opinion. It's going to be your cost of capital is a lot more, right? So instead of going out and borrowing to buy an apartment complex at 4% interest, that's fixed for 10 years, amortized 30 years, with minimal points, with high leverage, right? We're talking about 80% loan to value, where you only need 20% down payment to buy a large apartment complex. Now, that was yesterday's. Now, today is going to be a little bit more challenging in that it's going to be higher cost of capital, right? We're talking more so around the tune of 7% for a stabilized asset, or even higher if you're using bridge debt or construction financing or hard money, right? We're talking 10, 12, 14%, which is just astronomical and makes these deals just not work too well. Now, what does that do? That obviously we'll get into this in a minute, but since we as buyers and investors can't afford that, we're saying, okay, well, instead of giving you $10 million for that asset, we need it at $8.5 million. Why? Because our cost of capital is a lot more, and this is an investment property, right? An income producing investment property. It's not going to produce income if our cost of capital exceeds what we would end up getting from rent from the property. So there is certainly a balance between the interest rates and valuations or cap rates on a commercial real estate. Now, the other one is, we talked about cost of capital. The next one would be restriction on supply of capital. So, right, instead of going through with an 80% loan to value or 20% down payment, we're talking more so around 60 to 70% loan to value on even on stabilized products, right? That's where we're bringing 40 to 30% down payment in order to make these things pencil for the lenders. And so that's going to mean that we as operators, as syndicators, as investors, either need to come with more of our own capital, which means we can buy less, theoretically, right? Buy fewer products, fewer apartments, or we have to somehow plug in some mezzanine debt, preferred equity structure, and in which case, again, just changes the full dynamics of the deal and causes more downward pressure on valuations. So a lot is going on in the apartment sector right now, in the commercial real estate sector, and all of that is impacted by things like the availability of capital, as well as our interest rates. So what we're seeing right now, again, November 2023, we've seen the last 2 months, I want to say, last two cycles, the Federal Reserve has paused, has not increased rates anymore. Now, again, rewinding, let's talk a little bit more about the history of the inflation as opposed to just the structure of it. History back in October 2022, October 2021, right? That's when Fed Powell came on, Janet Yellen came on, and they started talking about that inflation was no longer a transient, right? It wasn't here coming and going, and then it would go back down quickly to 2%. no, this 8% inflation month over month is actually here. It's a problem. We need to do something to combat it. And that personal journey, we talked about this, but personal journey, that's when I stopped buying the speculative deals where we'd go fix a home, fix and flip a home. No more development deals, right? No more ground up permitted construction, because again, at that time, that's when we saw that the Federal Reserve would have to step in and do something to combat inflation. Now, going back to the beginning of this conversation, was knowing that what happens in the macro economy impacts what you're doing in the micro economy is super, super critical, right? If you were somebody, if you were an investor who was not paying attention to what had happened in October 2021, and you went out and bought a bunch of development deals, and you weren't overcapitalized, you didn't have a ton of capital in the bank for that cash burn that inevitably does happen, you could have been stuck in a bad situation, right? Again, I'm thankful that we had the foresight to say, okay, this is what's happening in the global economy. This is what's happening in our U.S. based economy. How is that going to impact my personal journey, my personal investing space? So if you're out there, and if you're wondering, I don't need to really pay attention to the macro economy, it's always, real estate is always going to go up. It's always going to go up. Now, I would say, so long as your time horizon is broad enough, sure, in most cases, but it's certainly not the truth in any amount of 12, 24, 36 month time frame. So always be paying attention to what's going on in the macro economy. I don't necessarily just mean, right, paying attention to stock markets or bond yields or any of that. I mean, really making sure that you're getting the resources right. Podcasts, I'll talk about that in a second. You're paying attention to the resources that give us this free information, that gives us updates on um, those what's happening globally. So those resources for me, Wall Street Journal, absolutely love it. There's a great daily podcast that I listen to, Wall Street WSJ Daily Debrief, great 7-minute digestible podcast. There's a couple others. Goldman Sachs has a weekly asset management call podcast as well. And then obviously, your slew of Reuters, Bloomberg, journals and articles that really keep me up to date personally on what's happening in the macroeconomic as well as geopolitical, right? What's happening from a global perspective, in terms of oil, and how does oil impact our local economy, right? Energy expenses. So make sure that you're out there paying attention to the global economy. Um, Moving forward, want to talk about inflation and where we think it's going to be going, right? Cooling inflation is absolutely critical. We have, and we are actively seeing that, right? So right now, we just got the CPI Consumer Price Index, which basically measures our cost, meaning consumers, our cost relative today relative to yesterday, or typically more month over month and year over year. Now, we just got our core CPI, and we were below what we were forecasted to be month over month, which is from a battle against inflation. That's great news, right? That really is going to help fuel the fodder of no more rate increases. Right? There's a fine balance between stopping or cooling inflation and deflation, right? There's a fine balance between those two. And the hope now is that we are not slipping into a deflationary standpoint. Right. Several people, several large conglomerates, ARK Investing, Walmart, actually are more speculative, thinking that we may be in a deflationary standpoint, and what that does to consumer goods, what that does to asset values is certainly detrimental. So obviously, you don't want to be flirting with that either. So again, CPI came in lower than expected. Great news. We've got another rate increase, another FOMC meeting in December. Right, that's going to be where the Federal Reserve comes on. Jerome Powell comes on, talks about what's going on in the market, and that's the point where they're either going to be pausing, increasing, or unlikely this time decreasing interest rates. And right now, especially with the core CPI and the CPI numbers coming in yesterday, a positive, below forecast, below median forecast, is the expectation that the market's expectation is that they are going to continue holding, right? They're not going to increase, certainly not going to decrease the interest rates. Now, again, one of the things that I talked about is making sure you're staying plugged in the macroeconomy. That is going to be right. What are we doing in terms of rate decreases? Now the market is pricing in rate decreases, likelihood of happening sometime middle of next year. Again, good news in terms of borrowing costs, and hopefully we leave it at that. Now, the next piece that I want to talk about is bond yields and the impacts there. So shifting gears a little bit back over to bond yields, right? Bonds are corporate promises, governmental municipality promises to repay a debt at a certain discount price. Now, what do bond yields have to do with real estate investing? The big thing that bond yields have to do is it's essentially depending on what type of bond you're investing in, right? If you're investing in a corporate bond or a local city bond or the U.S. government's bond certainly has different ratings in terms of their likelihood to repay that bond, both at face value as well as the actual yield, right? So the interest or the amount of money that you get back monthly for it. Bond yields are for most investors that are looking at treasury bills and corporate America bonds, I should say, uh, are really looked at almost like risk-free money, right? So if I go out and buy a treasury bill, a 30-day treasury bill, the risk associated with that is relatively low, very low, I should say. And what they are currently what the yields are currently paying out are in the upper fours to low fives at this point. I didn't check what it was this morning, but you can generally assume right now about 4.8 to about 5.2% yield on a 30-day bond and T-bill. And so what does that mean? That means I can go out, I can essentially invest risk-free, as close to risk-free as possible, in a treasury bill. And over the course of the next 30 days, if I put in $100,000, if it's a 5% yield, I'm going to be getting $105,000 back at the end of the period. Now, what and why that's important is if you're an investor, if you're an apartment investor, and you're considering, hey, should I invest in an apartment that has a ton of upside, right, via forced appreciation, market appreciation, or with obviously some cash flow associated with it, or should I just go stay liquid and put capital into a short-term treasury bill where my associated risk is next to zero? I'm getting essentially cash flow within a 30-day period, and I can keep rolling that forward. Now, I think what's important is, right, how are we positioning our ability to perform as apartment investors, and why should we invest our capital in an apartment as opposed to a risk-free treasury bill? So I think the big story there, in my opinion, one of the big stories that I like of why apartment investing or commercial real estate investing is so critical, as opposed to necessarily just a bond yield, is going to be something to the effect of obviously we've got the potential upside. So have to know the micro market, you have to know the asset, and you have to know the sponsor team, right? The management team who's actually going in and effectuating change and making those building out those assumptions and making actually executing the business plan. So super important to know your management team. I think the next one is going to be depreciation, right? So depreciation is one of the big things that really helps those from a wealth perspective to maintain wealth, right? So what is depreciation? How does it impact your bottom dollar? Depreciation can, again, what I did not talk about this morning was I'm not a CPA, I'm not an attorney, so please always consult your professionals there. But from a depreciation standpoint, what you can do and what you should be able to do is offset the gains that you're getting from the particular investment that you're investing in, right? So if I'm making $5,000 a year off a 5% yield bond on a $100,000 investment, that $5,000 then goes into my personal income bracket, which is then taxed at that whatever that level is, right? Whatever my taxable income is. And so that's, all well and good. I made $5,000, but if I'm being taxed at 30%, I'm I'm keeping quite a bit less of that cash that I just earned. Now, if you're investing in commercial real estate or residential real estate or anything that has depreciation associated with it, what can you do with that? Right, that depreciation should be offsetting the cash gains that you're getting from at least the cash flow of the asset itself. Now that's, a lot more powerful instead of only keeping 30% of 5,000, which is what is that, 3,500. Um, Instead of keeping 3,500, I get to keep all 5,000 if the numbers pan out the same. Obviously, when we go to sell, there's the upside that we do get from the sale is certainly going to be taxed as well. But from the cash on cash, from the cash flow standpoint, it's a little bit better in the real estate space, or something where you can actually capture depreciation. So again, comparison between apartments and bond yields, I think commercial real estate and bond yields is certainly something that you should consider, and especially with your risk-free appetite, with your appetite towards risk, your appetite towards upside, and then moreover your liquidity, your needs for liquidity, right? If you need to be liquid, right? If you expect to need that capital, that cash within a short some period of time, or if you're okay parting with that capital for several, 3 5 years, depends on whatever you're investing in. So again, bond yield is something certainly that you want to consider going forward in the investment space, and how you keep track of that, right? A couple different ways. Obviously, the resources that I mentioned earlier, WSJ, the daily brief that I got this morning is that bond yields are continuing from 2 days ago when we got the CPI numbers, that bond yields tanked or tumbled from their all-time highs down, and then since then have creeped back up by small basis points, single digit basis points. So again, going into and circling back and kind of closing out this conversation, macroeconomics, making sure that you as an investor, you as a person, you as a consumer are actually staying on top of your understanding, right, of how the macroeconomics impact your micro economy, and how that microeconomy judges and helps govern your investing strategy. So whether you're a real estate investor, stock investor, bond investor, whatever it happens to be, certainly want to make sure that you're staying on top of it. So really appreciate those that joined us today. Looking forward to next week's adventure, where we're going to be talking about the 2024 outlook. Right? If I had a crystal ball, what do I think 2024 is going to look like, both from the macro and micro economy? What am I doing in terms of my investment strategy? How am I positioning myself, my partners as well, for 2024 year of success? What I would say is, from a sneak peek perspective, is I am cautiously optimistic, and cautiously optimistic about continuing to purchase and operate apartments. One other thing to mention is that while it's not all said and done yet, the local city council has all but completed and finalized their tally in terms of who is going to be elected into the new city council. And from my perspective as a small business owner, as somebody who is vehemently disbelieves in rent control, and believes that the free market or essentially capitalism will do more benefit than harm, and that restrictive policies will do more harm than good. That the city council, who we think that is going to be winning based on existing or current results, is that it's going to be positive, right? And so, what does that mean for our city here? We've got I'll call it a moderate mayor, a moderate district attorney, and now we will have a moderate city council, as opposed to where we were before, which was very, very progressive, very far left. and we were certainly going towards the route of more taxes, more restrictive policies relative to land owners and property owners. So certainly keep an eye on that if you are investing locally. If you are an outside investor looking in, certainly keep an eye on the city of Seattle relative to the geopolitical space. Thanks, everybody. Really appreciate it. And if you found this valuable, please like and subscribe and invite others to this weekly podcast. Would absolutely appreciate it. And until then, go out and make it a good day. Thanks, everybody.